Hi, my name is Joey Finrow, and I'm a local real estate agent in Orange County, California. I work with everyday normal buyers and sellers that are families looking to buy and sell their primary residence. And I also work with a lot of real estate investors who are looking to buy long-term rental properties, such as single-family homes or multiple units. In this video, I want to go over why a lot of business owners, small business owners to large business owners, why am I seeing them adding real estate towards their investment strategy and their investment portfolio, and not just rely on stocks and the market to help fund their retirement and their lifestyle? I work with a lot of investors, most of them being, I would say probably 70% of them being small business owners or some sort of entrepreneur in some fashion. And I see that it is a fairly common theme that over time, as they're building up their career, more funds become available, and they're just looking for which asset, which avenue is going to help me fund retirement and give me security, appreciation, potentially cash flow, and also diversify against what their current portfolio looks like. For all those reasons, I'm seeing them come to real estate. I think real estate adds a couple additional benefits to balance the portfolio than maybe what's the stock market doesn't offer. Of the benefits would be depending on your CPA and how unique or complex you want to make this, there can be some very unique tax benefits adding real estate, but it is a little bit complicated. So I would definitely recommend, for the specifics of tax savings, when it comes to your specific situation, talk to a CPA that specializes in real estate and depreciation and all of that kind of stuff. But for one of them being tax benefits, that there's some incentives by buying a property, making it habitable, and then renting it out. The other one is depreciation. But with all that, a really good real estate CPA can help identify that. Benefit is why I'm seeing investors coming to real estate and adding real estate is that, again, it helps balance the portfolio. You're not just relying on stocks. You're adding another asset that is appreciating and cash flow, monthly cash flow to your portfolio. And if you use leverage, and what I mean by that is if you get a loan on the property, you can scale appreciation much quicker, because when you get a 6% return on the stock market, let's say you have a $500,000 portfolio, you're getting 6% of $500,000. But with that $500,000, you could buy a $1.5 million rental property, and you're getting 6% appreciation of that property of 1.5, not of 500,000. And so that's a second reason why I'm seeing business owners adding real estate to the mix of their portfolio, because long term, again, you don't make these moves to make money in 1 year, but 10, 20 years down the road, or for your kids' future, having that compounding of the total asset value, not just the money that you put in, that's incredible. A third reason is the tenant's paying your debt off. If you do use leverage and get a loan, the tenant's paying your loan off. Again, I feel like a lot of people don't really consider that as a benefit. Another one is, unlike the stock market, when you want to sell and go buy a different property, when you sell, from my understanding, when you sell a stock and go buy a different one, there potentially can be tax implications on that transaction. Talk to a CPA, a tax professional on that, but potentially there's a tax event there. But in real estate, if it's a rental property and you do what's called a 1031 exchange, you can defer that tax event to some time later in the future. And so that being said, you could start off with a single family home, 5 years later, exchange into a 3-unit apartment building. 3 years later, you can exchange into an 8-unit apartment building. You can keep moving up to getting different investment properties, and you can defer that taxes. The last benefit that I'll go over is you have a couple options in the future when it comes to financing, especially today in 2026. Rates are high. So buying rental properties today, the numbers don't look that attractive. But in 2 or 3 years from now, likely rates are going to be lower than they are today. And so with that, a lot of investors are going to refinance, and they'll do one or two things. Just bring down the rate and make the debt cheaper, which therefore raises the cash flow. So let's say you got a 6% interest rate. In 3 years, you got a 5% interest rate. So you lowered your debt by 1%, and potentially you could pull out 50 or 100 or $200,000. All this depends on the type of asset, how big it is, when you bought it for, and what is it worth today. But that's likely something that can happen in the future. What most investors that I work with and small business owners do when they do a cash out refinance like that, they lower the debt, pull a little bit of equity out, they go buy another one, right? And so we call that just recycling the same money, and it's really the market's money, but you're doubling down and putting it back on another property. And so over time, as you can kind of start to see, one turn into 2 to 3 to 5 to 8 to 20. If you do this, if you're strategic about this over 10, 20 years, you could really build up a secondary investment vehicle for you and your family. Let's say the business slows down or the stock market slows down. It's nice to have just another asset class that potentially can be different and give you a little bit more diversification in case of something out of your control happens. What I also tend to find my small business owners appreciate is that real estate, again, it's not get rich overnight, but it's get rich over 10 years. It's in the background, it's running, it's working when you're not working. And it also allows you as a business owner to make potentially bigger risks and bigger plays at work, knowing that you have different vehicles of investing going on in the background. And in real estate, if you do it long-term and you're not trying to get rich overnight, but you're going after long-term rentals, it's a very conservative, safe, and almost bulletproof vehicle that you could invest in. And so knowing that you have, it's almost like buying gold. It's, you know, if you hold it over the long term, it's going to go up. But why I like real estate way over gold is because I get appreciation greater than what the money I put into it. Again, the tax benefits, and there's actually cash flowing that can happen. You're not just holding it and it's just sitting in a safe. Gold is good, but real estate is different, is all I'm saying. And so having a smaller, sizable real estate portfolio is going to give you the mental clarity and the mental almost freedom to make bigger leaps and bigger risks at work, knowing that you have something conservative, safe, almost guaranteed. That it's like money in the bank, but it's appreciating. The purpose for the video is to go over why business owners are moving over to real estate and adding real estate to their portfolio. If you have questions on this, leave a comment below. If you want a list of multifamily investment properties that I would buy in Orange County, leave a comment below. I'm happy to send you that free resource. We'll see you in the next video.